Hello everyone. Today I want to talk about Meta stock, and I want to talk to you about what has transpired over the past few days and also what has changed going forward in terms of the stock price movement and what are the key drivers and overall analysis of what could happen, and also taking a look at what has shifted in the past. So, first of all, clearly there's been a big change in the share price movement. The reason why is because of the news, the overall sentiment change in terms of the guidance and also the overall earnings called, what the strategy has shifted in terms of Zuckerberg and his vision for the future going forward. I want to give some context. Going into this, post earnings after quarter 3 2022, the share price prediction was about $197 a share based on my personal analysis. I thought this could have gone at 197 easily over the next 5 years. It just so happens that it did that in a matter of months. So I want to go over, is it a good time to buy Meta stock? Or is it maybe not a good opportunity? Or maybe things have changed to a point where it's questionable. I don't know. Should we go left? Should we go right? Well, I also want to give a recap of what happened last year. First of all, if we're really looking at the shifts and looking at the changes, we can clearly see that there's been a stock price movement over time. We started off quarter 3 2021 at $378 a share, reaching a bottom quarter 3 2022 at about $88 a share. This is an over 76% decline from peak to trough. Now, what happened here? There was clearly a big shift in sentiment, not in terms of just only investors, but what was communicated by Meta themselves. The overall guidance for the end of the year forward looking at that time was that it was actually going to decline in terms of revenue. And this was something that had never happened before. And this was also something that investors didn't know what to do at the time. So there was a big sell-off. It happened very quick after every earnings call. And it was mainly an institutional push, but also overall, investors in general just didn't know how to feel about what the future was looking like. Now, I personally thought this was the perfect time to do an in-depth analysis on what the overall operations of the company looked like and also what that meant going forward. Clearly, after quarter 3 2022, there was a massive hike in the price. And although clearly if we take an out zoomed in perspective, then we can clearly see that the price hasn't really reached its highs, or at least its all-time highs. Although it's gone up 100% over the past few months, is there a buying opportunity? Well, I think the best way to answer that question, at least analytically and hypothetically speaking, is by looking at the overall analysis of their history. This is a company that has done extraordinary numbers in the past. This is double-digit growth rates, phenomenal performer overall in terms of their financial metrics and their overall business endeavors, probably in the whole country. This was an untouchable stock. This was an untouchable company. It was seen as pristine at its peak. And the massive change in tides really happened in terms of their guidance for 2022. The real question is this a short-term shift or is this a long-term shift? Well, one key thing to look at in terms of the company is for sure going to be their overall revenue outlook and their overall execution of that revenue outlook. Another key component is going to be that profitability overall. I'm not just talking about their incredible gross margins, but I'm also talking about their operating margins and their overall net income profitability. What really matters at the end of the day is that free cash flow for investors, to see that return on invested capital, to see those dividends come in. Obviously, they don't pay a dividend, but in terms of the conceptual framework for thinking about it, what are you returning to the investors? Obviously, this is a phenomenal business, but what do you price it at? I think some key drivers for this company are clearly going to be revenue growth, it's going to be gross margins, it's going to be capital expenditures, big investments into the future, such as the metaverse and any other endeavor that the company might have. And also looking at the negative risks. Like, for example, they have a history of facing big legal settlements. They have a big history of facing ill will from consumers in terms of their ethical practices and so on and so forth. Any changes that have really happened in terms of guidance. Before we go into that, I want to talk about 2022 numbers. Were they good? Were they bad? We clearly saw that the company stock price skyrocketed all the way up. Way up. But is that because of good numbers or is that because of good guidance? Well, as we'll see here, earnings fiscal year 2022. Actual versus my expected. This is my personal expectations that I posted right after earnings call on quarter 3 2022. This was in the 1st of November. After I finished listening to the calls and doing my analysis, I said, all right, this is what I expect by the end of the year for fiscal year 2022. And this is what actually happened. If we're just taking a bird's eye view of what happened here, it obviously came pretty close. But that doesn't matter in terms of the stock price movements. That doesn't matter in terms of the share price. What matters is how much of a shift there is, how much of a discrepancy, and how much of a change in guidance there really is. Because the future doesn't look the best it's ever looked compared to the past in terms of the US stock market. And there are clearly some macroeconomic shifts that are changing the overall consumer sentiment and overall investor sentiment, at least from a retail perspective. If you look at it here, honestly, in my opinion, I think there were a lot of surprises, small surprises, but they're still surprises. There's definitely a lot of negatives. So the negatives come overall in the sense of profitability. So you look at operating margins, you look at net income and so on and so forth. That seems like it kind of declined. And based on the earnings call, it seemed like there were some shifts in terms of SG&A, in terms of overall operating expenses and so on and so forth. Obviously, inflation has changed certain things. The procurement of services and overall execution of that has stayed somewhat stable. What's really bad is the spread between their prior year growth and their current year growth. Revenue growth declined by 1%, as you can see here, when we're used to seeing double-digit growth, let alone a loss. This is a big shift that changed the company outlook. What I will say, after crunching the numbers, is you can clearly see that there was a big beat in overall free cash flow. My expectations were based off of profitability, revenue growth, and also capital expenditures. What you'll see here is that their net working capital has really changed based on what I was expecting. Net working capital here declined while mine was projected to increase. Obviously, you can't predict everything. There were some shifts there in terms of assumptions. But now, what does that mean in terms of what I'm going to value it as? Well, if I'm looking forward through a 5-year perspective, I can see here that based on the past numbers, based on the context of the macroeconomy, based on key drivers, like I said, revenue growth, tax rates, gross margins, legal expenses, blah, 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 everything going forward, there's going to be some changes. And after earnings, there were definitely some changes in guidance. Now I want to talk about what those drivers are. If we look here, if we look at what the assumptions were, is that initially you can say that in the past they've done something around an average of 19% growth. You would probably assume a lawsuit provision for any worst case scenarios in terms of what the company might expect in a bad case, and a tax rate of, let's say, 19%, and maybe capital expenditures of 27 billion, given their past. But obviously, the past is not indicative of the future. You can use it for context. You can get a bird's eye view of how things have panned out, but that's not really going to give you key insight as to what the future holds. That's not a crystal ball. So, post-guidance, things definitely changed. So what I want to talk about is what I thought was a good price based on these assumptions that I made before the call. So before the call, doing all the math, assuming a 3.5% growth in the long term, assuming a 10% required rate of return for my investments, that's just me personally, assuming the $40 billion stock buyback program, you probably got a current price of an implied share price of $245 a share, just about. This was a big buying opportunity. Now, the current price, let's say it's $185 a share, for example, you have a margin of safety of about 33%. So even if you have some miscalculations, even if you have some deviations, you still have a cushion of 33% of margin of error. In this case, it's a margin of safety. Is that accurate, though? Well, after the earnings call, things clearly took a turn in terms of the strategy shift. Mark Zuckerberg said there was going to be a year of efficiency, and there was going to be more of a focus on the key components that investors prioritize. Obviously, that's not verbatim, but that was the indication and the overall context and the nuance to the conversation that was held throughout that whole period. There were plenty of mentions over the call of a year of efficiency. What that means is focusing more on the profitability. A key driver would probably be daily active users and also the revenue per user, as well as the monetization of Instagram Reels and advertisements and so on and so forth. But what does that mean for the bottom lines? Well, revenue growth based on guidance, 19%? No, that was not the guidance. To break that down, on a 6-year historical, revenue has grown 28% on average. Okay? 5-year average, 24%. All right? 3-year historical, 19%. That's what I was using as my assumption. 1 year, as we saw, -1%. Now, for fiscal year 2023 guidance, it was actually said to be -2%. So what does that mean? If we change our assumptions in our calculations and put it at -2%, all right, and we say based on guidance, which was actually said to be a tax rate of 22%, capital expenditures, guidance said it was actually going to be $33,000. All right, I'm going to include the lawsuit provision just as a safety net for my personal investment. The implied share price goes down to $160 a share. Now, obviously, this is based on guidance. Given my experience with how the tides have shifted, I think it's going to be a case where Meta tries to beat expectations. And I think it's going to be at around -1%, which is absolutely horrible. It's honestly disconcerting for an investor because this is a company that used to post double-digit growth rates, and now it's showing a decline year over year. This is showing a big shift into the overall strategy of a business. They clearly need to invest in their overall endeavors going forward to keep driving that revenue growth. That's only going to happen through returns on invested capital and being astute with their overall investments. The metaverse is clearly a big component of that, but this goes all across the board. Monetization of Reels, Facebook, WhatsApp, your overall revenue per user and how you're providing value to advertisers. That's what's really going to drive it in terms of the business. Let's say you change your assumptions and maybe say 20%, flat 20% tax, and you just make it an even 30 billion in terms of capex. Well, even still, you have an implied share price of $168 a share. All right, so clearly you can see there's a big spread between the share prices. So I think a big component to look at is a sensitivity analysis. Where can the price really go? If you're a person that wants a higher rate of return on your investment year after year, if you're investing in 5 years and you just want 10%, 10%, 10%, or maybe you want 20, 20, 20, 20, or maybe you're like, you know what, I'm cool with 4% every year. Whatever it is, this shows your deviations in terms of what you might want. Go anywhere from 7 to 13 in my opinion in terms of what I require as a return. And as the perpetuity growth, if I were to hold this stock for the rest of my life and assume a growth rate, what would it grow at year over year forever? Well, honestly, personally, I wouldn't assume a growth higher than 3.5%, even though it's posted great numbers. Why? Because the overall historical GDP growth rate of the country has not exceeded 3 to 3.5%. You're really going to expect it to outgrow the overall country in an infinite term? I don't know. That's just your assumption that you have to make. But whatever you do, whether you're conservative or a little bit more aggressive, this is the overall ballpark of what you're going to get. So, this is what you really have to think about. Based on my analysis, I think that the stock price has already had its run. If we look here, if we were to have bought at $88 a share, let's put that here into the analysis. Let's assume that it's at $88 a share. You would have had a margin of safety of about 92%, all things being equal in terms of my analysis. Obviously, this is not financial advice, but it is to show you the relationship of the context of the news, of the macroeconomics, of the shifts in the tides and the share prices, and how important it is to capitalize on opportunities, especially when you see big volatility changes. So based on what your criteria is, this could have been either a massive opportunity or a massive opportunity to step aside. Me personally, after looking at what the price can do, let's say it goes up to 190, 199, somewhere around that range, it's looking like it's fully valued. So in my conclusion, I think guidance has changed, the strategy has shifted, moves were made, and the shares popped accordingly. It seems like that shift in the overall strategy has already been priced in, but that can always change over time. As we see through a chart, there's a lot of upside potential if you really think that this was a fair valuation for Meta. Me personally, I think there's so many things that changed. I mean, at this point here, there was no revenue decline. There was no shift. There was no adverse competition changes like with the likes of TikTok, with the likes of Snapchat, whatever. Maybe you might not think those are really big drivers of the competitive moat changes that the company has seen. You can definitely agree that the numbers have changed. Whether that's good, whether that's bad, that's up to you. But it's always important to keep a good analysis of how things have panned out. I think given the current run of the stock price in such a short term really shows you how much of a greed level there is in the overall share price. Might be moved by institutional investment, but overall, I think it's fully valued, and it might be a good idea to keep analyzing, but also to be patient. Again, this is not financial advice, and it'll be very interesting to look at this company going forward. All right, thanks, guys.